Hello and welcome to Bold Radio. I'm your host, John McLeese. Sometimes in life, you just need some good advice. No one is an expert at everything. That's why we're proud to present the Bold Radio Expert Series, where we welcome a qualified and experienced individual to offer sound advice on an aspect of running a business. Our guest today is the highly qualified legal expert. We are pleased to be joined by Marc Marion, lawyer and partner at the Winnipeg law firm Taylor-McCaffrey LLP. Marc will be bringing his expertise today on the subject of structuring the ownership of owner-operator businesses. It's been said small businesses are the lifeblood of our economy. Many small businesses are comprised of this simple business structure known as owner-operator. We'll discuss some considerations that need to be made when structuring an owner-operator business. Marc, welcome to the program.
Hi.
It's great to have you. Can you explain the basic terms, or in basic terms, I should say, what is an owner-operator business?
Yes, an owner-operator business is essentially any small business where the person who owns the business is also the person who runs the day-to-day operations of the business. So small businesses in Canada account for more than 90% of all businesses. So there are a lot of owner-operator businesses out there. Owner-operator business can be found in many different industries like construction, transportation, restaurants, retail, wholesale sales, and personal and professional services.
So there's lots of these types of businesses exist, certainly around Canada and here in Winnipeg. How do you structure the ownership of an owner-operator business?
Yes, so the ownership of an owner-operator business will vary greatly depending on specific circumstances. In many cases, a business will simply start off with a self-employed individual or sole proprietor, or where there's more than one individual, for example, spouses or two or more business partners as a partnership. And then over time, the business will evolve to the point of needing to incorporate. And then in other cases, a business will start from the outset through a corporation. And then the shareholders will most often be the principal operators of the business. But in other cases, they'll also include outside investors such as family members or close friends. And in other cases, you'll even have owner-operator businesses structured with more than one corporation. There'll be a corporation operating the day-to-day operations, another corporation holding shares of the corporation, and you might even have a corporation owning the land and building out of which the business is actually operated.
So what would be some of the reasons for structuring your business as a corporation? Taxation, liability?
Yeah, so that's exactly it. So the greatest reasons are limiting the exposure to potential liability, and the other is tax planning. So those are the significant reasons. So by incorporating a small business, the owner generally limits their risk of liability to the amount actually invested by them in the business. So in other words, if a claim is made by a creditor of the corporation, for example, in negligence or breach of contract, only the assets of the corporation are at risk of satisfying a successful claim, as opposed to the personal assets of the shareholder being at risk. And then other reasons, as I mentioned, is tax advantages like tax deferrals or income splitting opportunities. Again, it includes easier access to capital and financing, more stability, and less business disruption because, of course, if a shareholder passes away, the corporation is nonetheless going to continue on.
So lots of differences between an owner-operator business and an incorporated business. What are some of the tax considerations that an owner-operator business needs to consider?
Yeah, so the tax considerations often include, for example, the opportunity for a tax deferral. So a private corporation in Manitoba pays a combined federal and provincial tax rate of only 11% on its profits of up to $425,000. So that basically gives you 89 cents on a dollar for profits up to $425,000, which allows the owner then to then reinvest that capital back into the business instead of paying a higher rate of tax on it. So that's a significant advantage. Another one is it allows the opportunity for income splitting with adult family members, such as a spouse or adult children, or even parents, by introducing them either as direct or indirect shareholders. And then finally, incorporating a small business allows the opportunity to claim the capital gains exemption. So every resident in Canada is given a lifetime capital gains exemption allowance of up to $800,000, which is indexed to inflation. And this capital gains exemption applies only on the sale of shares of a small business corporation, but it doesn't apply to the sale of assets. Hence, the opportunity of accessing this exemption if you're incorporated.
We're talking about structuring the ownership of your business. Marc Marion joins us. He's a lawyer and partner at the Winnipeg law firm Taylor-McCaffrey LLP. What are some of the considerations, Marc, in determining who should be directors and shareholders of a corporation if I decided to set up a corporation for my business?
So in regards to directors, normally you're looking at who's actually involved in the business of the corporation and who should have say in the significant decision-making and strategic orientation of the corporation. They also include issues concerning liabilities because directors of a corporation are subject to statutory liability for a number of items, such as unremitted source deductions in respect of employees like income tax, CPP and EI, or uncollected or unremitted GST owing by the corporation, or again, unpaid overtime wages owing to employees. So these are all items directors can be personally liable for. Therefore, if a spouse, for example, is not actively involved in the company, normally it's advisable not to have him or her as a director. In regards to shareholders, it often comes down to who should have voting control of the corporation and who should participate in the equity of the corporation. So in some cases, it makes sense to include a spouse and adult children, and in other cases, it doesn't.
Succession. Let's talk about that as our final question. Very important whether you're in a corporation or in an owner-operator business. What are some of the considerations and options in planning the ownership succession of a business?
So whenever you're thinking ownership succession, you always have to have in mind what are the long-term objectives or retirement objectives of the owner-operators. You discuss with them, who the natural successors of the business can be, for example, adult children or employees. So, for example, if you have a child you want to leave the business to, you can either gift the shares to the child, and there's obviously going to be tax consequences with that. The parent can also decide to sell shares to a child for value so that they actually get value for what they've created. And then there's also the possibility of the parents retaining the value and simply gifting the growth in value to the children and let the children benefit from that growth. So this can apply to either adult children or even employees. But regardless of which option you choose, it's always good to consider a shareholder agreement to regulate certain exit mechanisms and also to prepare properly worded wills and review them periodically to make sure that they align with your long-term objectives.
Structuring the ownership of a business can be complicated, but not if you have the right expert. Marc Marion, lawyer and partner at Winnipeg law firm Taylor-McCaffrey LLP. Marc, thanks for joining us.